Good evening, sir. Today I, Merin Thomas and Khushi Gurnani will walk you through the three-statement model of Reha's Cafe. Reha's Cafe is a 4-month-old business here in Lavasa and it is owned by a family. Let's walk you through the assumptions that we have assumed while creating the model. We have assumed that the revenue will grow at a rate of 10% for the next 5 years, and then we will have a fall in the growth by 5%, and then in the last 2 years, that is the 9th and the 10th year, we will have a 0% growth. Here we have assumed that on the basis of the location and the age of the business, that the growth rate will change. The next one is cost of goods sold. Here we have assumed that every percentage is calculated on revenue. The raw materials is 8% throughout 10 years, wages is 4% throughout 10 years, transportation cost is 3% throughout 10 years. The operating expenses, that is the employee cost, marketing and CGA, are also calculated on revenue. Employee cost is kept as 10% throughout the 10 years is because we have assumed that this being a...
Now I'll be walking you through our income statement of the model, as we have assumed in the assumptions that our business will be growing at a 10% for the 5 years, and the next 3 years it will be growing at a 5%, and the last 2 years of the model, that is 9th and 10th year, it will have the 0% growth. So as we are assuming that we'll not have any great growth after some years, so we have decided not to provide discounts from the year 2025, that is from the 4th year, and the net revenue will be also increasing as we go throughout the year, and the revenue will not be increasing in the 9th and the 10th year. It will be staying same as constant from the 8th year, as we are expecting there would be no any growth in the businesses. Same goes with the total COGS and EBITDA, EBIT, EBT and net income, as the net income is growing throughout the 8th year and the 9th and the 10th year stays constant. We have explained it in the dashboard as by taking net income and net revenue as the variables in our dashboard, and we are having an upward growth in our income for the next 10 years. Next, we have the balance sheet of our business, that is the total assets in the balance sheet at the first year were 8,85,650, and at the end of the business, that is the 10th year, it is 1,16,13,178. Same goes with the liabilities, that is 8,85,650 at the first year and goes increasing, and by the 10th year it is 1,16,13,178. Here for the balance sheet, the assumptions made here are: our accounts receivable percentage of revenue is 2%, accounts payable percentage is 1.5%, and deferred revenue is 0. Here we have debts of 2 lakh, net borrowings of 2 lakh, debt repayment of 10,000, interest rate at 5%, and interest payment is 10,000 at the first year. Now I have the fixed assets of our business, that is furniture. The asset life is for 15 years and the price for the assets were 3 lakh. Steamer, asset life 10 years and the cost of the asset was 25,000. Utensils for the 15 years and the cost of the utensils was 50,000. Refrigerator for 15 years and the cost of the refrigerator was 50,000. The total capital expenditure was 4,25,000. Next we have depreciations. The depreciation for the furniture stays constant throughout the year, that is 20,000 for the furniture, 2,500 for steamer, 3,333 for utensils, 3,333 for refrigerator. So the total depreciation is 29,167.
I'll walk you through the statement of cash flows. In the statement of cash flows, first we are taking the net income from the income statement. We have three major heads in the statement of cash flows, namely the operating cash flow, the investing cash flow, and the financing cash flows. We have kept in mind all the assumptions that we discussed earlier in the video, and we have made the model for cash flows.